Hello, investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. Well, I'm recording this on Black Friday, November 23rd, which is the day after Thanksgiving. And I'm starting off with a daily candle chart of the VIX going back for the last 12 months. And as you can see, I've left my lines on the chart from last week so you can see how the forecast panned out. And I'm going to save you from the suspense and tell you that none of the forecasts that I put out last week hit any targets. And that raises a very big caution flag, because if the markets are not moving according to the technical signals in a bullish fashion, then we have to be very, very defensive moving forward from here on out and into 2019. As you can see, the VIX moved up this week, and remember, this is inversely related to the S&P, so if the VIX moves up, the S&P will move down. The good news is the VIX held this resistance point. It finished filling this gap, and so the gap fill rule applies here, and what that means is 80% of the time after a gap fills, the market reverses. So what I'm going to do is erase this line and redraw my forecast for next week, which I do believe is going to move lower on the VIX, just like that. So notice the angle at which I'm drawing this line. It's basically the same angle as what we had back here and back here. If I were to draw a line here, they'd almost run parallel. So that's number one. Number two, while the stochastics is not showing an overbought condition, it is showing a position at around 70.30. So 80 is overbought. 80 or higher is overbought. But I still believe that we're going to go lower in the VIX. Now, with that said, let's go to the S&P. SPY is the ticker symbol that I'm analyzing here. It's the ETF for the S&P 500. And you can see that this week, the candles gap down. I'm going to erase all lines. We did not go up, but I think we will go up next week, and here's why. We have a good strong support level for the S&P right here. We have very small candles that are known as spinning tops here. The S&P is showing oversold right there with a reading of 5.6. Now remember, it can't go any lower than 0, obviously, and that's the bottom of that indicator. So that is an extremely oversold condition. So I think the stochastic is going to start moving up, eventually crossing the D line here, which would be a buy signal. There are also two gaps above the market. There's one right here, and there's a very small one up here. I do believe that by the end of the year, the S&P is going to rally up to fill that gap on the upside. This is going to be a 2 to 2.5 week forecast, and I'm going to keep that in place. The other thing that's positive for the S&P is that while the prices were dropping, the volume was also dropping. And that tells us that the sellers are losing some of that momentum. Now, we're going to have to keep an eye out for Monday, because the Cyber Monday numbers will come out, which has now become an economic indicator. And it seems as though people are holding back on Black Friday and refraining from going out into the public to go shopping. And I believe that the bulk of the sales are going to happen online, probably on Monday, maybe even Tuesday, as some companies will even extend their sale days. So that's for the S&P. Now, as I move to the Russell 2000, which is a more broad-based index, you'll see we're forming a W bottom right here, more or less. You have a double bottom right there. That's acting as support. I'm going to move this line over, while at the same time I'm going to keep that resistance line in place. I think we can move up just like that. This is going to be a 2-week forecast. Leave that in place. Stochastics is oversold, and the K line is starting to move up. That's bullish. And so with the end of the year about to hit us right here in December, we are also expecting the Santa Claus rally, also known as the year-end rally. That usually happens in the last week to 2 weeks of the year. Now, as I go into the diamonds, which is the Dow Jones Industrial Average, I'm going to point out some very critical numbers that you have to pay attention to, because if we don't get that Santa Claus rally, then that could mean that the market is setting up to reverse its upward trend and possibly work into a bear market. So we want to, again, be prepared for that, while at the same time protect our accounts against any downside movement. Now, if I go to the diamonds, this is the Dow Jones Industrial Average ETF. You can see that we gapped down. These are all red candles, 4 in a row. That's known as a stale red light. That's bullish. We have a gap above the market. That's bullish. Stochastics is oversold, starting to turn up. That's bullish. And the volume is dropping on the way down. That is bullish. So I'm going to erase this line right here. I'm going to move this one over. Again, I think we're going to see a rally next week and the week after. So I'm going to put that more or less at an angle that mimics that angle, but from back here. So these two upward legs would be running parallel to each other. And this line down here is what we have to pay attention to. If you notice, the low for today hit that trend line. Let me back up to show you how significant this is. If you are watching the technical charts, I strongly recommend that you follow what I'm saying right now as a word of caution and put together some kind of a risk management plan for yourself. This is a 3-year upward trend line right here. See, I connected all these lows. We are bouncing, or at least touching, that trend line. If we see price movement below the market right here, okay, if we see a breakdown of that trend line or a breakout below that trend line, and you start to see the volume bars moving up, that's our signal to move to cash. Basically, the charts are telling us, watch out below, support is breaking. We also have the possibility of a double top up here. I talked about that last week. And as I go back to the daily chart, you'll see that each and every day, that support line, because it's heading in an upward direction, that trend line is going up, each and every day, that get out point is going to be a higher number. So we are flirting again with the possibility of us being faced with a bear market scenario. And I would not mess around with this one, because we are looking at the possibility of the end of one of the greatest bull markets of my lifetime. And I wouldn't want anyone to get any buy ideas and start thinking, okay, I'm going to buy because it's a sale day. If you start to buy on the way down, that's the same thing as you trying to catch a falling knife. And you have to be very, very careful. So I'm going to leave this as resistance. I'm going to leave this line with the end of that line being my target. I'm going to leave this line in place to remind everyone about when to get out if that trend line breaks. And I'm leaving this one up here as a secondary resistance point as we move higher, or should we move higher. So that's our weekly market report. I want to thank you for following us. I hope you had a great time with your family over this Thanksgiving weekend. For those up in Canada, I hope you're following along with our reports as well. And I look forward to speaking with you next week. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.